Hello everyone, welcome back to another Quantower video. In today's video, we're going to discuss something known as the range bars. Okay, so we'll go into what range bars exactly are, how we can use them, how we can apply them even like a normal candlestick chart, what you see on the right side, and what is the difference between these range bars and a normal 5 minute or any time bar that we have, 5 minutes, 15 minutes, 30 minutes, it all depends. Okay, so after we've seen this, we'll dwell a little bit into how to implement these range bars into the footprint charts as well. So you can have, for example, when you're looking at the footprint, the most common of them that is being used is having a footprint on a 5 minute chart. The next step is having them on a range bar. For that, you need to understand what the range bars are and how do we exploit it, or how do we use it, what is the significance of a range bar. So firstly, on the left side, as you see, we have a 5 minute chart, and on the right side I have a range bar. So let's start with how do we set up these range bars, or how have I set it up for the bank nifty over here. A lot of you guys have doubts about the charts and the settings. So what I'm going to do is I'm going to publish another video in the coming few weeks where we'll discuss how I have set up my charts. Not only this particular chart, this is not that difficult, the footprint charts and the market profile and so on, so that you have no, we are all at sync at how these charts are and how you can exploit them or use them rather. So over here, as we all know, what we have to do is when we have to select any time frame or anything, so you can straight away go here and you can see this settings bar. So when you have a normal candlesticks chart, you generally go to time and select it, and the others we can discuss later. So as of now, what I have on is range bars, and I have selected 200 ticks. Now again, for someone who is new, one tick is 5 paisa for our exchange. It is quite common. So what 200 ticks means is you have to simply multiply it with the the 5 paisa is your one tick range. So you multiply 200 into 5 paisa, what you get is 10 rupees. So what essentially this is doing is I'm having these ranges or these bars getting plotted at every moment of 10 rupees or 10 points, like that you can say in bank nifty. So what does it mean? Whenever there is a 10-point move, only then will the next candle be plotted. For example, if it stays within this, let's say these 10 points for say half an hour, the next candle is not going to be plotted till the time the next this range is breached, and then the next bar starts. So whenever this 10-point range is breached, the next bar starts, although the next bar might intrude into this range, but that is how it is plotted. So again, by this you can firstly get to know the volatility of an instrument. So if you see this is the later half of the day, if you go and see at this point, you can see the market is ranging within, you can straight away see 20 to 30 points at max for let's say from 1436 to about 1441, 43. So this is about 8 to 9 minutes the market was ranging. So what you get out of this is, similarly over here you see about 10, 15, 20 minutes the market was in range. Now this is one thing, one advantage of using a range bar. Of course you can do this here also, but this again gets a lot cleaner and tidier, and you can exactly pinpoint when the market has moved and at what point the market has moved. Now the other interesting part that happens with this is, where things start getting interesting is when you have these volumes plotted. Again, this is the color scheme that I've employed. Again, I've discussed it in my past videos. I will do a proper video on this, how to set up these charts in the later section in the coming few days. But just to show you how I have done this is I have set it as per the percentage over here, and this is max value calculation is that the max threshold limit is only for this chart session, and again I have different colors set for the percentages over here. This is not absolute, remember this, you can have that as well. Again, we'll discuss it later. I have set it to percentage, okay, and then I get this whenever it breaches, let's say 25% of its certain percent the particular session threshold, this will start changing colors. Okay, so if you want to see, I'll just contract it, and you can see over here, and you can see these colors changing whenever it is breaching certain limits, so that it is easier for me to see whenever there is a big volume. Now whenever there is a big volume, that is the place I'm going to get interested. Okay, so we'll just see a few cases, 2 or 3 or 4 of them, so that you understand how these range bars work and how you can make them or use them to an advantage. Now the next question that keeps coming to a lot of people's mind is, how do we use or decipher where a trend has changed, or let's say for example it was within a range and now it is moving ahead. So a lot of times people want to in with the expiries coming that so often, people generally try to fade these moves. For example, if we can see, let me get a rectangle tool out. So if we can see this, this is a range that is happening. Okay, now what you would like to generally do is let's say you would like to short this place, okay, these places, and you want to go long in these places. This is a range that you have established. Now suddenly for some reason, or let's say whatever the reason is, the market breaches this zone and this happens. And what generally new traders or even experienced traders fall, or let's say the psychology gets in the way, is when this breakout happens, they're still fading the market. Now this is where you start revenge trading and a lot of stuff happens. Okay, let's not drill into that, but let's assume that we are in this range and we want to know that how to firstly get to know that we have broken a range and not get trapped into this particular thing when it is broken out. So as I keep repeating again and again, there are places when you go with aggression and there are places where you go with absorption. Okay, so what is the difference? Aggression is when I am seeing someone step in and for example, let's assume at this point you had let's say a lot of sellers getting trapped. We'll get into that a little later, but I'm just explaining the basics over here. And a lot of sellers, and if you see a delta bar, it will be pure red, a big red bar. So what I mean by that is a lot of sellers have got trapped, and this is an absorption that has taken place. It's gone up, and I've seen a lot of buyers getting trapped here. It's absorption. So I'll keep doing this till the time we are in this range. So that is what am I doing within this range? I am trading absorption. Okay, I am not trading aggression, I am trading absorption. You cannot be all the time having both in your mind. So when I'm in this range, I have made up my mind that whenever I am reaching over here, I'm going to trade absorption until unless this range breaks. Where did I get this range from? From the range bars that I plotted. So having a general look over here, let's say these are 10 range bars. So I need, this is a 100-point range. And if the bank nifty keeps trading with its 100 and 150-point range, I'm going to simply trade absorption. I'm not going to look for aggression. What do I mean by aggression? By aggression, I mean whenever there is a huge delta or a positive delta bar, a huge delta bar, there is going to be a positive correlation. That means that if there is a huge positive delta, the market is going to go up. Okay. As soon as this range breaks, now I'm interested in positive delta. So the next thing that we're going to do is we're going to go to the indicators tab and we'll add one more thing. Again, I'm doing this so that we're all at the same level and we can understand what is going on here. Okay, so what I'll do is I will go here and add something known as the delta bars. Okay, and I'll keep the setting same as of now. Now in the same range bars, I have added another tool that is the delta bars. Okay, you can add cumulative delta, whatever, for ease of understanding. What I'm doing here is I am simply adding the delta bar. Okay, now when I go over here, okay, so this is one place. Let's assume there was a range before this and it is broken down. Okay, now this bar, I will just get my marker on as well. So immediately when I see this bar, this is the bar. Okay, and look at the volume and look at the delta. So I know that this range, so if you're looking in a 5-minute or 4-minute time frame or a 1-minute time frame, what you'll just, obviously a low time frame will get you more accuracy, but in a range bar, I immediately know that this is the place, exactly this place. This is the place where the maximum volume has stepped in, and this is the place where a lot of buying delta has come in. Now, if it was a range, let's go back. Okay, okay, so this was a range before this one. I will again get the rectangle tool, and you will see how this range bars become so intuitive and is so helpful. Now this range has broken. Now before this range was broken, did you see what happened over here? You see this huge delta come in and the huge volume. Now this has not happened within this. Of course, it has happened on the lower segments over here. So we'll not go into the past. We'll go into this particular segment, and this is applicable for all range, these ranges, these rectangles that we've plotted over here. Okay, so just before this range was about to break, you see a huge volume surge over here. Okay, this is the bar, If you see, this one was a bar. Okay, so it's closed on a negative delta. So obviously the first reaction for us is broken down the range, and we are now going to trade absorption, because this is what has been happening in the past few minutes or 15 or half an hour or so, whatever. So when we see this bar, I'll just show you this bar. Okay, so this is the bar, I think, yes, and a huge volume has happened, and a huge delta surge has happened. And what does the actually the price do? It closes on the bottom. So this is a red bar. So again, this is a delta divergence, and the bar starts moving down. So you will not be wrong if you initiate a short trade. Okay, you will be absolutely right when you do that. But then you see the market go up, and let's say your stop loss are here, and it takes out your stop loss, or wherever your stop loss is. It is bound to happen. It is okay to take the stop loss, because remember, in the previous 3 or 4 times you have been successful in doing this. So uh, always be aware that you will not get everything right, and consider this as a good thing, that now, since the range has been broken, you know that the range has been broken, and it's been broken with a good volume and delta. And these buyers that have come in are not these trapped buyers. They intend to hold this range when this has happened. Okay, so unlike what has happened in the past, wherever this positive delta would have happened over here, like see, like this bar over here, and these guys have got trapped, and you would playing the range, and you traded, and you got your points. It has been happening, but over here it has not happened. So now you will not trade, or you will not fade the range till the time a range has been established. So this is a range that is established. How do we get to know? We'll just look at that. Okay, the other clue that you get is, if you look at this range in the previous during the previous times, it was generally going to the lower segment of the range. During this segment, suddenly the range has contracted. Okay, so this is a signal that this range is going to get breached quite, I mean, it is going to breach in the next few minutes, or 10 minutes, 5 minutes, whatever it is. So this is a signal that the range is going to breach. Now it is not necessarily it's going to breach here. Sometimes this happens, it goes there and breaches this way. So always remember, don't preempt, wait for the market to show you what it's going to do. Our aim is to react to what the market is doing. So let's say we have given a stop loss, and the market has gone up like this. So immediately I know now my range has been established, and this upper segment is my range. This is the place where it happened. So I mark this zone whenever it has happened. Now whenever the market approaches this lower zone, I look over here, and you see again, this is a negative delta, and the bar has closed on top. So I know this range, and I play my odds, and I go into a long over here. Anywhere you can go over here and expect whatever your stop loss is. If it is one bar or 2 bars, let's say 2 bars, that means 20 points somewhere here, and you're expecting at least 1:1, 20 points or 30 points, 3 bars. So you can go ahead and plot your targets with respect to bars, because these are range bars of the exact same amount. Okay, now this has happened. Now let's go into one more tool that you can add. This is again for beginners, or if you're new to this, what you can do is you can add delta divergence as well. So immediately you know the places where the high volume is, let's say over here. Okay, so if you're too aggressive, now look at one volume that has happened here. So what has happened here is this, again you can see a lot of volume has taken place, and look at the delta, it is positive, but the bar has not closed negative over here. Now let's go over here again. This is the bar, so I can see the market is moving towards here, and the buyers are pushing in here. So I have not seen any sort of delta divergence, and I can see within this range there is some sort of aggression, and no sign of let's say an absorption yet, and something of an absorption was seen over here. Okay, so as I said, this is not the point where we go short. Why? Because we've not established a range. Okay, so when you see some range that is at least 3 bars close below the topmost bar of this range, is when you start drawing your range or boxes like this. Okay, now the first time this happens is somewhere here. If you look at over here, that is why I plotted this delta divergence for people who are new and who cannot track the markets or these things quite fast. You have these this indicator that you can switch on. So when you go over here, you see a huge volume. This is all positive delta, and look what the bar does. So now what you do is you wait for the market to come here to initiate your short. But what the market does is it comes here and goes long, it doesn't give you a significant time to actually go short or long. Even if you do, again, our range is not established. That is why I generally do, what I tend to do is I generally like 3 bars to close, and it has not happened here, for me to establish a range. So this has not happened here. Over here it has started happening, and this is where I draw my zone. So you can see this happening a lot of times. Whenever you see 3 bars, again, you will have to check back for every stock or every index. Every index has their own range. For example, I've said it 200 ticks. Nifty will not have 200 ticks. Okay, you'll have to do it, let's say, for a 60 tick or an 80 tick range bar, and you'll have to do this and check this on a regular basis. On some days the volatility will be more, and the range bars will be, let's say, not 3 bars or 4 bars or 5 bars, and so on. So let's keep that for some time later. Let's understand what is happening now. The next time it happens, again, is somewhere here. Okay, and the 3 bars, this is a huge volume bar, and it happens somewhere here, and there are 3 bars that I've closed. So I draw my range and I draw my rectangle. Now it's become a lot easier for me. So whenever the market comes here, I'm going to go long. Whenever the market goes there, I'm going to go short. And whenever I see this signal on the top, these delta divergences, or this is not the place to go short. It is too early because I've not had my range. People who are aggressive can try this, but again, you will overtrade. That is why it is always advisable to wait, and wait for your wait with patience for your setup to show up, and then trade. Okay, so within this, if you see, it is hardly 15-20 minutes, and you get your first long trade over here, if you notice. Okay, and you get your delta divergence here. So this is the place where you should actually be taking your first trade in the long direction, and this is the place where you should actually be taking your first trade in the short direction, and so on. And again, if you have a 3-box target and you want to keep 2 box as your stop loss, it again depends on you. If you're a little more aggressive, you want only 1 box as your stop loss and 2 boxes as your target, or 1.5 boxes as your target, it's your wish. Okay, so you can keep doing this and you can establish this range. So again, now when do we see we will keep doing this. So let's count how many times we get our trades. Again, it will not be possible to take the trades all the time. 1, 2, let's say 3, you've got your 3 boxes. 4, okay, it doesn't touch, and we don't get our trades here. Now when you don't get your trades here, as I just spoke a little time before, the market has stopped going below this. Okay, it's stopped going below this, although you've been shorting it. You see, when you're doing this 3-4 times, and when you've done here, and look at what has happened now. This is one step, this is one step, and look at what has happened here. It's gone even above this. So when the market comes here and it gives you another opportunity, you have to be very, you can go ahead and short. I'm not saying you have to try all your attempts, because we don't know it is going to break out. And when you give your stop loss, this time you have to take a step back and see what has happened, especially if you've given your stop loss on a big volume bar. Okay, so look at this bar, look at what has happened in this bar. So this is the same thing that happened in the previous range bar. It has happened again. So now you've got to look and wait. Okay, so this is your range and it has been breached. Okay, so do I initiate a long trade? No, because we are trading ranges here. We are not going aggressive. Remember, you cannot be trading both aggression and absorption. Like what I said in the beginning, it will harm you. You will switch one to the other whenever your trades are not going in your favor. That is why I'm saying, because of the psychological point of view, you're always better off trading only one thing. Okay, so now when it's breached this, I know this is the point. If you look at it, there was a delta divergence. Again, if you've gone short, there is nothing wrong in this. Okay, although if you've seen this happening, there is nothing wrong. You've gone short and your stop loss has been hit. Okay, so out of the 4 trades, this is the first time your stop loss is hit. So you've got 3:1. So let's say 70%. Let's say out of 5 trades, you got only 3 right and 2 wrong. Okay, let's assume that it's quite okay, because your risk reward is in your favor. It's okay to have 60% or 65% hit rate. Okay, now when this is breached, what do I do next? I wait for the range to get established. Okay, I need at least 3 bars. So what do? I go here, and I know this is my range bottom somewhere here. Okay, just a minute, and range bottom, and I go ahead and I see these 3 bars getting formed here. Okay, so the next time I come over here, let's assume I have shorted again over here. okay, because this is the range that I established. Let's shorten this range, and I got my 3 bars over here. So I, let's say I assume I plotted my range and this has happened. Again, I've hit my stop loss. So let's say 3:2 is what has happened, and it has formed again. And the next time it happens is this place, okay. So this is where I plot, okay. The next time it happens here is when it happens this place. What the first thing that I would have done actually when we lost a trade, we would have actually initiated a long trade here or somewhere here, okay, and we would have actually got one here in this range and then lost one here. So it is actually you won in this range. Let's talk only about range, these ranges. So I've lost one here, won one here and lost one here. Now the range at this point was not this much. Why I'm saying that is it was this much, okay. So I made one winning trade over here whenever the market approached here, and I lost one trade, and when I lost, my range criteria now changes, and the next time I get 3 points, 3 bars is somewhere here, okay. Now again I will wait, and the place from where the breakout happened is somewhere here. So I've changed my range criteria because this is the place. I think I just shorten it even further. This is the place where I started losing, okay. Now I wait for a delta divergence somewhere close to here, okay, or here, and let's say if this stop loss also got hit, I got another trade over somewhere here. And before that happens, let's take this place, okay. So I will get my shorts over here till the time the range breaks, and we will keep doing this. And even if it is 50 to 60%, let's say your hit rate is 50 to 60% and your risk reward is 1:2, you will always be profitable. Now I am simply not, I have not got into the details, into the footprint part. We'll get into this in a later video. I am just going by the bars over here, okay. So your hit rates will be one, even if it is 50-50, you will end up being profitable in here. But what I'm trying to get is, you will not be trading rash. You will not be trading by, what do I mean by rash? You have a strategy in place and you're going as per the strategy alone, okay. So whenever I'm having the lower end of the strategy, and whenever I see a delta divergence, I'm going to go long, okay. So let's say this is my range that I've established, okay. And whenever there is a delta breach, so when this stop loss hits over here, I don't wait, and as soon as it gets inside, so let's assume it is not I just forgot to tell you something. As soon, let's assume that this is the range that we established and we hit our stop loss and the market goes back inside a range. So we're back inside the range. So again, when I see a delta divergence on the long side, I will go ahead and initiate my long and target again one bar or 2 bars on the short side, and 3 bars will be my target, and so on. So whenever the market breaches a range and gets back into the range, what we can generally expect is, this is a concept of market profile, but you can apply it in all range bars, is if we break a range, okay, and we get back into the range, the destination trade generally becomes the next end of the range. This you will notice even on a 5-minute bar, it is difficult to plot a range here. But when you've seen something like this, and especially if it happens quite quickly, okay, what do I mean by quickly? If it is breached and within 1 or 2 bars it's come back inside, generally this is called a breakout failure. Generally the target is the next end of the range. So you can do this. Now in this session, we've simply not gone into the footprint part, how we can use imbalances also with this. I've just gone simply into the using the range bars as of now, and just by pure candlesticks, the delta bars, the high volume bars, and so on. The other thing is, the last thing before we end our session over here is that these zones, okay, now let us further improve the improve our edge, okay. Let's improve the probability of our edge. How do we do that? Okay, whenever you've seen these high bars and high delta bars, and wherever this action has happened, what you do is, let's take out all these drawings first, okay. You can have them on when you're plotting the ranges. What I'll do is, I will just show you how you can increase the probability of this particular thing by another 10-15%, okay. When you see something like this happening, okay, and this high volume bar, which has not happened in the past, so many bars, a high volume bar accompanied by a high delta bar, and the market has not gone inside, okay, so it has broken a range. This is the first step towards aggression. Whenever you've seen this aggression bar, what you do is, the first thing you do is wherever this has happened, you do this. Okay, you go here and you make it blue. This is going to act as a support. Let's change the fill color as well. Okay, make it blue. Okay, and let's get it back again, and I'm going to expand it. Okay, so this is my support. Okay, similarly, when I see aggression on the short side, when the market is going down, if you keep doing this as well, only this. Okay, so this is the bar, and let's have the same thing done over here. Okay, so let's see, this is the bar if I'm not wrong. Okay, and what you can do is, if you want to not waste time again and again, you can have this saved as your default also. So what you can do is right click, so you can go ahead and save it as default also. Okay, so if you do this, it will save as a template or save as default. So I will just do, if you want a blue for buying zone, you can save it as a buying template and so on. I'll just set it as default. We don't want to waste a lot of time here. And if you keep going and plotting these zones, you will find them to be very, very helpful. Okay, so let's take out this, and whenever the market touches these zones, you will suddenly find you have a great, let's go over here, and this was the bar if I'm not wrong. Okay, and I will go here and plot this over here as well. So you can see that. Okay, so it's plotted on its own. So now I have my zones. Now whenever I'm drawing my ranges, I have my zones. So whenever this particular thing is tested the first time and you have a delta divergence, most likely this is again a higher probability trade. You will get your 2-3 boxes as your targets. Okay, so this is the next step in adding more information in the strategy we just discussed. Okay, so you can go ahead and plot these on all time frames. You can go ahead and increase it 300 or 400 ticks. I've done this because I just wanted 10-20 points to explain it and get these signals more, so I can explain the strategy better. As and when you spend time and you go and back test it, or rather forward test it, you will find this to work beautifully, and you will have these support resistances marked exactly at the zones. I'm not drawing anything from lines. I'm drawing it from pure order flow and footprint. I have not gone into the footprint as well, but I'm using just volume and delta to plot these zones. And you can have these zones marked and look at a 5-minute chart or 15-minute charts, and you will notice that these zones are so powerful when you have used this volume and delta along with this. Okay, so hopefully this video was of some help. We will surely have one more video, a follow-up video, where we'll go into the footprint part as well and more into the range bars with footprint enabled. Okay, until next time, thank you, bye bye.